Today I want to talk about Uber and Uber Eats. I picked out this company because I think it represents a recent phenomenon exhibited by a lot of different investors who tend to be enamored by those household names because of their exposure to the company from a user's perspective. I think companies like Uber that have yet to make any profits years after establishing their business pose a threat to the economy at large. Also, I picked Uber because it is quite close to home as I am currently in the restaurant industry. So Uber Eats to me is an app. However, to the investors in Uber, this is not just any app. It is a $15 billion app. According to first quarter 2020, Uber Eats did $819 million in sales, which accounts for 25% of total revenue. Now, Uber IPO'd with extremely high valuation as well as aspirations. Even though it has yet to make any profit, it's considered to be an industry disruptor in both the share drive and online delivery industries. So let's take a look at what Uber disrupted in each of those businesses. Uber driver today currently make $29,493 per year, and their average fare for each 5 miles is around $16.70 under a normal condition. And drivers from taxi industry, which Uber wiped out back in 2013, was making $32,071 back in 2010 when converting to today's money using a 3% inflation adjustment. So drivers from the old taxi companies made more money than today's Uber drivers 10 years ago. Also, given the app being more efficient, Uber drivers today are actually able to complete more trips per hour than the taxi drivers back in the days. Today's driver had to drive more trips in order to achieve an earning that's still under the taxi drivers earned on average 10 years ago. However, Uber was able to lower its fare by $1.60, which is a benefit to the end users. And now let's look at Uber Eats. All the restaurants are projected to generate $532 billion in sales, up from $427 billion from 2014. And that was the time right before Uber Eats came out. So upon first glance, it seems Uber Eats did help with the growth of the sales. But since the restaurant raises their pricing by an average of 4.4% per year, the real growth between 2014 and 2020 is actually a negative 0.7%. However, minimum wage and inflation are real, and they account for 9.1% of the increase to its costs. And even though online sales growth was 94% year over year, the total size of the pie did not change. So Uber Eats did not really create additional value to the business owners. What it did was it cut out a piece of the pie by introducing a 30% fee into the cost structure of those business owners. And this fee represents roughly a 1% erosion of its total sales. But that's not the scary part. Online ordering is projected to grow to account for 40% of all restaurant sales by 2025. And according to this projection, the potential sales erosion could be as high as negative 12.4% by 2025. And by that time, lots of restaurants will not be in business anymore. Because in this industry, a typical profit margin is paper thin between 6 to 10%. And a good to excellent operator might be able to make 20%. When you introduce a 12.4% erosion of their top line, a lot of the businesses that used to be profitable are just struggling to break even, and others are just making a very small profit. Operators who often find themselves going along with Uber Eats just because it is a very difficult prisoner's dilemma. 30% commission is simply too much for operators to swallow. Uber did not really create any real additional value, but only damaged existing businesses while delivering services at a price level that is not sustainable, as shown through their losses. And the next page, I will show Uber's achievements to date. Not only did it hurt existing players, Uber did it in such a noble way that they made sure that they also come out as unprofitable as possible. Between the years 2012 to 2019, Uber managed to lose a total of $22.6 billion. And since its inception in 2009, it managed to receive $24.7 billion and also currently carries a long-term debt of $7.2 billion. Despite aspiring to create additional employment opportunities, none of its 5 million drivers are receiving any type of unemployment benefits, sick leave, or healthcare. I know this manager from a local restaurant called Shaking Crab. She has all three benefits. And now let's look at the financial performance for Uber over the past 8 years. Ever since it received its seed investment in 2010, Uber was able to grow its sales, but its losses also grew as sales increased. Any normal business would over time see their sales and profits start to converge, but for Uber, the gap just continues to get wider and wider, especially after it hired its current CEO in August of 2017. After paying him an astronomical $200 million signing bonus, the drop accelerated under his excellent leadership. At the end of the first quarter 2020, Uber turned its initial $1.25 billion investment into a $22.6 billion loss, which is represented by the Great Triangle. Uber is losing billions of dollars. The CEO is making $45 million a year. The time for Uber to break even has passed 9 years ago. At the moment before they started making any sales, that was the closest point to Uber from breaking even. And just by looking at the trend of this chart, I do not know how long it's going to take this company to make up this great triangle that they already dug themselves in. And if I were Uber's investor, at this point, I really don't know how to root for this company to either sell more or to miss their revenue target, which probably also means less loss. So this created the conundrum that is Uber since its inception. Like I said, with a $1.25 million investment, it somehow managed to deliver a negative 240% compounded annualized return over the past 10 years. In this process, they reduced the average driver's earning by 8% and destroying a already stagnant restaurant industry by introducing a 30% additional cost with negative real growth to the overall industry. And since 2012, it managed to grow its revenue by over 800 times, while also growing its loss by over 400 times. But one thing we have to give to them is they were able to lower taxi fare by 9%. The cost is investors $22.5 billion. Divide this cost by the total number of rides Uber's drivers delivered, it comes to $4.40 per ride. Uber currently offers the rides at 16.7. Adding this additional loss, even if Uber charges their service at $21, they will still just be barely breaking even. If you remember the old taxi industry, they were able to charge only $18 while paying their drivers more and making a profit. Uber's entrance into the taxi industry not only destroyed a once profitable business, they are also a much less efficient operator who are not able to break even. On Uber's mission statement, it says that it wants to bring transportation for everyone, everywhere. Its vision is smarter transportation with fewer cars and greater access, transportation that's safer, cheaper, and more reliable, transportation that creates more job opportunities and high incomes for drivers. While Uber did realize some of its vision, the actual impact of Uber's disruption also accomplished a number of other things. So based on the actual impact to those industries, whether intentional or not, I rewrote their mission statement to reflect reality. And here it goes. Our mission is to provide cheap and convenient share ride and delivery services to the end consumers at the expense of the well-being of current industry participants and jeopardizing the ongoing viability of the restaurant industry. We will subsidize and groom millennials to get used to a level of leisure and comfort that is unsustainable without us incurring losses at a rate of no less than 50% of our revenue growth. We have successfully demonstrated through zero value creation in this industry, our vision and position to be the leader and pioneer that bring destructive forces upon what once were healthy and profitable businesses. And they accomplished exactly that. And when I saw their first quarter financials, I really am at a loss of words. Given the current stay-at-home environment, which is a very favorable situation for Uber Eats, it still managed to lose more money despite having record-level sales at $819 million. Their $300 million loss is only on the service level and not taking into account of any of their research and development and other corporate expenses. So if they cannot make money now, How many stars need to align in order to make this happen? Despite the disappointing results and $1 billion loss in the first quarter, it still manages to pay its executives $227 million in stock-related compensations. If this were any small business owner doing exactly that, they would be kicked out by their partners. However, when this happens on a much larger scale and in the public's eye, somehow it is acceptable. The amount of loss that Uber have accumulated over those years will take a very successful company like Netflix 10 years to make up. What about the time value of money? So when you purchase a share of Uber today, what are you really trying to do? And if I tell you I will most likely lose all of your money and have proven without fail over the past 10 years, will you still think that this time that I won't? Irresponsible behavior and inefficient cost control is the exact reason why Uber turned profitable industries into money-losing black holes. It extracted what would be profits for existing businesses and turned them into revenues that have no way of covering their astronomical costs. Like no one in the restaurant industry or taxi company is getting paid a $200 million bonus for taking the job and then $45 million a year. We're all just small business owners who need to be very cost effective in order to earn our profits. We cannot afford to fail because we don't have the billions of dollars that Uber does. The taxi companies used to be able to pay their drivers more while charging only $18 and remain profitable, and somehow Uber can turn that into a money-losing proposition even at $21 per trip. Uber is just one of the many currently being highly valued and traded on the stock exchange. Out of this entire list, only Amazon was able to make money after year 9. Airbnb was able to make some very short-lived profits, but is now facing a much tougher environment. Maybe the existence of the very list legitimizes each other's failure and provides a safe haven for incompetent management or downright faulty business models. And if in fact this is a commonly accepted outcome, then I would have very deep concerns. I want to bring your attention to these two graphs. The one on the left is a timeline that represents the percentage of unprofitable IPOs by year. In this past year, we have reached a level only matched by the dot-com bubble era. And the one on the right is even more mind-boggling. The unprofitable IPO enjoyed a price appreciation that is 200% more than profitable ones. The market is filled with irrational and speculative money that have no regard to fundamentals or even bother to understand business model. And I think this is the danger because the names of those companies are already so familiar with the average investors who are currently either using their product or services, and we feel like we know the company and we forget to look even deeper under the hood. And with so many people using their services and products, these companies still cannot generate any profits. And instead, they continue to spend recklessly in an effort to take on additional market share. And such spending are very inefficient allocation of capital as diminishing marginal utility kick in. And with so many people already using their services, if they cannot make a profit, they may never be able to. And I'm sure some of these companies will fail, while others may rely on marketing revenue to turn into profitability. But guess what? Businesses that used to have the money to place those ads already have their normal profits arbitraged away by the so-called disruptors. And when those companies fail, as we the people will no longer be able to enjoy things we're already used to, because all this time, what we pay for those services were under true cost. The reason we were able to enjoy those luxuries is because those companies are leveraging the entire economy to subsidize our needs. And when this bubble bursts with no fresh capital coming in, then everyone will be forced to correct. But hopefully before that happens, we can pull ourselves back and really think about what we're buying when you purchase that share of Uber stock. If you're still not convinced, I now introduce you to my next big idea. We are launching an app called Slobber Feeds. Slobber Feeds lights up your world. Our slogan is feeding the world one spoonful at a time. And right now, we're doing a call to action. We're seeking seed investment round for $1 million in exchange for 1% of equity ownership. And at Slobber Feeds, we provide slobber feeders at your fingertip. No matter what the occasion or the location, we're here to cater to your needs and spoon feed you anything of your choice in a manner that is customized to your unique chewing pattern and digestive system. In order to encourage you to download our app, we now will pay you $100 and additional $50 for each subsequent appointment you book with us. Based on the current market conditions and investor sentiment, we expect to be able to raise enough capital to feed everyone in America at least twice. Don't hesitate. Subscribe to the channel and capture this once-in-a-lifetime opportunity.